All, all right, everyone. I have created this slideshow to guide me through the video. Today, I would like to talk about the technical analysis, and I am about to cover just the basics of it. So if you are an experienced guy in a TA, this video is not for you. This presentation is for people that are new to this concept and they would like to start a proper investing or trading. So let's start by defining technical analysis. I would define technical analysis as a short-term to mid-term price analysis of an investment, which is made based on price changes, maybe volume changes, order book changes, and some other technical indicators. Technical analysis is used to determine the probable change in prices in the future based on their past evaluation, considering factors that may have an impact on development of their supply and demand. So basically, we are using the historical price performance to determine the future by looking at the trends and indicators. As you may know, the past may not be the greatest indicator of the future performance, but definitely TA is widely used and it helps in making a good investment decision. So technical analysts would consider past price movements, disregarding the outside information or fundamental analysis. I'm not saying this is the best idea, however, this is probably the main assumption here. For me, when I'm doing trading, I would consider TA and also fundamental analysis when I look into technicalities of some cryptocurrency or maybe some information in the news that I know about this cryptocurrency. Basically, coming back to TA, basically people that use technical analysis believe that all the information that is out there is already presented in the price movement. This may sound disturbing and crazy to the early investors. However, the basic assumption of technical analysis is that the demand and supply decide about the asset prices. Even the proponents of fundamental analysis can't argue with this obvious assumption. After all, the law of supply and demand is one of the basic economic laws governing the markets. Basically, by using TA, trader can determine changes in the demand and analyze the current expectation of the future price movement. And if you had basic economics, you may know that the expectations are one of the factors that can influence the demand. Another assumption is that the present value discounts the future. This is basically the same assumption, but let's talk about it. This means that if we believe that so let's look at some examples. Let's say Apple. If we believe that the revenue of Apple will grow in the next year because they are, creating a new phone or new product, then this information will be already reflected in the current prices, right? You read the news, you're excited about it, so you buy it. By buying it, you basically bump the price up. Let's go over here to the Morningstar and let's look at Tesla. Here we can see that the price to book ratio is 12.0, which means that the current market value is 12 times greater than the book price of all the assets owned by the company. Further, you can notice that Tesla has not generated any profits. By going over to this tab, you can see that, and you see that they haven't generated any profit for the past few years. So now you have a question. Why the price is so high? Well, investors are expecting great things from Tesla, and they truly believe in the success of this company in the future. If you had finance classes, you may have heard of dividend discount model or cash flow discount models, which is based on this particular assumption that the current price reflects the future performance. The other key characteristic of a TA is that the TA is self-fulfilling, which means that if I use the same indicators or trends as other investors, we would make very similar decision. If I see that there is a long-term bullish trend by drawing a trend line, which I will show in just a second, other guys somewhere else, maybe in, I don't know, New York or LA or Asia, are seeing the same situation, and they are most likely to hold that particular asset for the long term. Okay, so there are two ways of doing TA. You can look at the historical price action by drawing graphical patterns that are giving you some critical information, or by simply drawing a trend. Here I'll just go over basics. I'll not introduce any graphical patterns to you. However, I will talk about trends. Other is to use indicators, which are just a statistical approach like price moving averages or relative strength index, short RSI. This tells you the current state of an asset price, of a price of an asset, and can be very useful in determination of price trend reversal, like from bullish increasing price action to bearish decreasing price action. I know this may not be clear to you right now, but let's move on and let's introduce candle charts. So you may know the price charts that look like this. Let's go over here to this tab, which is just a line that gives you an information of a closing price in a basis you selected. In this chart I'm looking right now, I'm using daily basis. So if you use line charts, you would know what the price was of this asset at the end of a day, at the end of your basis. If it's an hour, you'll be at the end of the hour. However, in case of candles, which look like this, let's load it, they give me more information. So let's go back to the slides. Here we see the opening price in a given time. In our case, one candle represents 1 day, and the closing price at the end of that day. Also, it gives you the info of how the price was deviating during that 1 day by looking at the daily high and daily lows here and here. Also, as you notice, green candles represent price increase. Closing price is higher than the opening price. We can call this candle a bullish candle. On the other hand, red one is a bearish candle, which represents price decrease during 1 day. Closing price is lower than the opening price. All right, so let's talk about trends. We can divide them on 3 subcategories. Long-term trends, where you would use weekly or daily basis to determine the trend, and you would probably want to consider or look at least 1 year of price action to draw that trend. Midterm, you would consider weeks or months and use daily basis as well. In case of short-term trading, you would look at maybe hourly basis for the past few days or weeks. So let's go over here and let's look at this chart. Let's try to draw a trend. Here I'm using